So breakaway gaps like right here are usually the beginning of a massive move towards the upside. But how can we as traders identify and trade these gaps, and what are the different types of gaps that you need to know about? Well, in this short video, you will learn all about the most important price gaps and a step-by-step trading strategy you can start using to make money. But alright, so before we can start trading using gaps, we of course need to learn about, what is a gap in the first place. And in very simple terms, a gap in trading is an empty space on the charts where no trades occurred. So this happens when the price opens above or below the prior close, and some traders actually don't consider it a real gap unless we see a gap between the wicks. So what do I mean by this? Well, if we have a candle, this is the first candle right here, and then we see another candle right here. So some traders only consider it a valid gap if we see empty space between the wicks right here, while some traders see it as a valid gap as long as we see a gap between the real bodies. And as a rule of thumb, you can use both these methods, but I think the most important part is that you as a trader, you need to decide if you're going to use wicks or if you are going to use candles. I think that using wicks to really, find the best gaps is usually the way to go. So you want to see a space between the wicks here. But as I said, some traders consider it a valid gap as long as the candles are gapping. And why does these gaps happen? Well, they can happen because of things like news, earnings, or events that happens outside of the normal trading hours. And we will talk about this later. This is a reason why we mostly see gaps in the stock market. You can find gaps in the crypto market and Forex market as well, but they are much more rare. And the reason we are seeing so many gaps in the stock market is because, as you know, the stock market are only open for certain hours. So if the market gets information during, for example, the night, this can lead to a massive gap. And we have two main types of gaps. We have the gap up, and this is when it opens higher than the prior close. And as I said, sometimes even above the prior high. So this is if we're using wicks or real bodies. And we also have the gap down, and this is when the price opens lower than the prior close. And sometimes we even include the wicks. But now let's take a moment and talk about where gaps occur most often. And as I already briefly mentioned, the most common market to find gaps is in the stock market. They are very common in the stock market, and this is because the market has, daily market closes. Every night the stock market is closed, and every weekend the stock market is closed. This gives the market lots of time to get new information, and this new information is what creates the gaps in the market. We can also see gaps in Forex. This is a bit more rare, but for example, on weekends, the Forex market is open 24 hours, but it's closed Friday to Sunday. Not the whole Friday, but it's closed during the weekend. So there we can see gaps. We can also, in rare cases, see gaps in crypto, but this is very rare because, as you probably know, the crypto market trades 24/7. But you can find gaps in, for example, the futures market, for example, the CME futures that does have these pauses. In the futures market, you can also find gaps when, for example, markets reopen after overnight or weekend pauses. And by the way, guys, futures is a very important topic. If you're a trader, you really need to learn about futures. And I do have a video where I go over the basic of futures. I highly recommend to check that video out after this video. But right, so now let's switch the attention and take a look at the most important types of gaps. And the first gap you need to be able to identify is known as the common gap. And the common gap is a small sort of everyday gaps that happens within a range bound market. And they are usually not caused by any significant news or something like that. This is just normal sort of order imbalances. And what is important to notice about these gaps, don't worry, we will jump into TradingView soon so I can show you one of these, is that they tend to fill quickly, and they are not really, at least in my opinion, they are not really good signals. But it is important to be able to identify the common gaps so you can actually avoid trading them. And here is just a quick bonus tip, a market structure insight, that if the gap either stalls near support resistance, or even more importantly, if it's inside a consolidation, the odds are of a full fill are high. But right, so now let's actually jump into TradingView and let's see if we can find any of these sort of common gaps that are not significant. Remember from the intro, we talked about this gap right here. This is a very important gap, but this is not a common gap. A common gap are these very small gaps that happen most of the time within sort of ranges. For example, right here, you can see that NVIDIA traded pretty much in a trading range. So if we can find a gap within this range, it's a common gap. So let's actually try to use the Wicks method. So for example, it's a bit hard to see. I hope you can see, for example, between this red candle and the high of this candle, we had a small gap. I know it's hard to see right now, but we had a small gap right there. But this is one of these gaps that are not that significant because it happened within the range, and many of the times these gaps will also be quite small. Another thing you can notice about this chart is that if we use the candle method, you will have tons of gaps happening all the time in the markets. So that is why I preferably use the Wicks gap. We want to see a gap here between the wicks. But now the next gap I want to talk about is the breakaway gap. And this right here can be a very profitable gap, so make sure to really pay attention. This is a gap that starts a new trend. Many times this will be the beginning of either a new trend or at least a massive move. So this is a very, if you are able to identify these breakaway gaps, they can be very profitable. So this is when we are breaking out of, for example, a consolidation or a chart pattern. And what is common of all breakaway gaps is that we gap above, either gap above a resistance or below a support. And one important thing that we want to see in order to really confirm that this is a true gap is that we want to see strong volume, because the more volume we have, the more market participants are agreeing that we're talking about a strong move. These gaps, when we see a real breakaway gap, they rarely fill quickly, and sometimes they don't even fill at all. If you don't know what a fill is that is basically when we have a gap. So we have a candle right here, it gaps above right here. So a fill is when the price goes down and sort of fill this gap, and many times it will bounce after that. But when it comes to these breakaway gaps, they will usually not fill. The price will just gap up and then just continue. So a gap through a major structure level, for example, if you are swing trading, maybe even a multi-month high, you can find this as a day trader as well. But remember that gaps usually happen overnight, so we usually look at, for example, daily candles when we look at these gaps. But when we see a break of a key level and maybe we see some bullish candlestick follow through, that often signals a genuine breakout. So now, after learning about breakaway gaps, you probably are able to identify what kind of gap do we have right here. Well, no surprise, this right here is a breakaway gap. Why is this a breakaway gap? Well, first of all, you can see that this was a place where, by the way, we're looking at NVIDIA on the daily time frame. This right here is a place when we broke key resistance. And what you will also notice if you look down here to the volume indicator is that we saw tons of volume coming in. This is something that indicates that this is a true, sort of a true breakaway gap. And by the way, guys, if you for some reason don't have TradingView yet, don't worry, guys, because I do have a special link to TradingView. You can use that link and you can try out TradingView Premium for free for 30 days. And if you, after the free trial, still feel like you want to continue, then you will get a $15 bonus on your new plan. So if you don't have TradingView, make sure to use that link. But now let's take just a quick look how we could have potentially traded this breakaway gap. So here it's very simple. We see the gap and then we usually wait for the candle close to really confirm the gap, because we want to know that we had enough volume and so on and so on. And a common way to set your stop loss is to actually set it very conservatively just below the candle, because when we see these breakaway gaps, many times, like we saw in this example right here, many times the price will just continue to explode higher if we see this lots of volume and so on and so on. But I can also already mention that when it comes to trading, not all breakaway gaps will of course not succeed. So when you have a tight stop loss like this, you will have to, many times you will get stopped out. But if you use a tight stop loss and maybe you have a pretty large risk to reward, let's say we have a 5 risk to reward ratio. In these cases, you don't have to win a lot of trades in order to, it's enough to maybe have a 30% win rate and you will still make lots of money with this kind of risk to reward. And now when we are talking about breakaway gaps, I do want to talk about an example that just recently happened here on Google. Because if you look at this chart, we are on the daily chart on Google right now. You can see that this right here was the old all-time high for Google. So because this was the old all-time high, this is a very key market structure level. And by the way, guys, if you haven't learned about market structure yet, this is something you have to learn about as a trader. And I do have a full market structure trading course. So make sure to watch that video after this one. It's quite long. So if you don't have time today, save it to a watch later playlist. But what I want to show you here is that we had this all-time high, so lots of traders are paying attention to. We actually broke out here, but the price, as you can see, the price then came down and tested the level once again. But then something beautiful happened. You can see that we saw a massive breakaway gap. You can see this gap right here, beautifully gapped up a lot. And you can see that since this was such a big gap, we can actually also see if we had lots of volume here. Let's just open up the simple volume indicator. You can see, if you look at the volume right here, you can see insane amounts of volume, right? So this is an indication that we have a real breakaway gap. And, since that gap, Google has just been continuing to pushing higher. And this is impressive because if we look at the market here, we can, for example, see that today the market is not really up a lot. It's up 0.20%, while Google is trading up almost 2%. So we are seeing lots of strength in Google, and this comes after this massive breakaway gap. But right, so the next gap, which is yet another very important gap, is the runaway gap. Another name for this gap is a continuation gap. Why? Well, because this is a gap that happens within a trend. So as you can see right here, it appears mid-trend and it shows that momentum is accelerating. So if we, for example, have an uptrend and then we see a gap right here, this right here is a runaway gap. And this basically reflects that more traders are jumping in as the move gets stronger. So here, the structure used, it often lines up with, either trend channels or Fibonacci extensions. By the way, if you want to learn more about Fibonacci, I do have a full course about that as well. No stress to watch it. Just make sure to save it to watch later or something like that. And we can also, of course, look out for strong candle closes in the same direction as the trend. So let's actually jump back here into TradingView and let's see, can you see any type of runaway gap in this market? Well, if you look closely, you can see that we had this breakaway gap we talked about. Then we saw 1, 2 candles, but then we saw yet another gap. And this right here is actually, what kind of gap is it? If you want to, let me know down in the comments. Well, this right here is a runaway gap. And why is it a runaway gap? Well, it happens when the trend towards the upside has already started. So this right here is a beautiful runaway gap. You can trade it pretty similarly as the breakaway gap. You can enter at the candle close. But if you had a tight stop loss on this runaway gap, you can actually see that you would have gotten stopped out, because here you can see an example of a gap fill. So we see the gap, the price comes down, fills the gap right, and then moves higher. So this is actually an example when many traders will actually wait for the gap fill here and try to enter on the fill. So that is yet another trading strategy you can use for gaps. All right, so last but definitely not least, this is a gap you need to know about, and this is the exhaustion gap. So this is a gap that occurs near the end of a strong trend. And what we usually see here is, remember what makes a gap strong is things like high volume and so on and so on. So when we are talking about the exhaustion gap, we're actually looking out for low volume, and we're looking out for another opposite of the breakaway gap, and that is weak follow through. So this signals that the demand, if we're talking about a gap towards the upside, or the supply, if we're talking about a gap towards the downside, right, is drying up. And once again, here you can use market structure and you can use price action. You know, in order to trade gaps effectively, you really need to know about price action, and I do have a full course about that. Make sure to check it out. But if the gap here forms near a key support and resistance level and is followed by, you know, maybe a reversal candlestick pattern, maybe you have like a shooting star, hanging man or something like that, the odds of a trend change are relatively high. So in this case for NVIDIA, this was not really a breakaway gap, but one thing I want you to notice about these last two candles is that during the day we actually saw a gap, because you can see that this candle closed right here, then the next candle opened right here. So here we actually, the price gapped up quickly, right? But then during the day, the bears managed to push the price down, and what do we see here? This green candle together with the red candle is a clear price action signal, because this right here is a BE. This is a bearish engulfing pattern indicating a reversal to the downside. And if we just let this replay play out, you can see that this marked at least a local top here. As you know, NVIDIA is right now trading much higher, but you can see that this marked a local top, and the price actually eventually went down to the previous support, right? Even dipped a bit below. I actually don't remember what happened to price after this, but you can see that the price eventually bounced off this support. But right, guys, so as I mentioned in the video, if you wanna, really master gaps, you have to master market structure. So when you have the time, I highly recommend to check out this course next.